and welcome to Wednesday's Targets in Focus. I'm Doireann Mc Dermott and today I'm joined on the line by George Davis, Chief Technical Analyst at RBC Capital Markets in Toronto, to have a look at the euro dollar, dollar yen and dollar CAD. So welcome, George. Now, if we look at the euro is trading near 4-month lows today against the dollar. Now, this is due to concern over the Eurozone following Cyprus's bailout and ongoing political uncertainty in Italy. The euro originally rose on the news of the bailout, but now we actually see it suffering. George, are you feeling quite bearish on the euro?
Well, in terms of thoughts on what's happening right now with the euro, we continue to see downside risks persisting for the currency going forward, and that's based on a couple of reasons. Number one, from a technical standpoint, we have seen over the last couple of weeks the euro post not only a bearish trend reversal, but on Monday it also broke below the 200-day moving average at 128.80. So that basically reinforces bearish sentiment from a technical perspective, and the next downside target over the very short term would be the lows from last November that come in at 126.62. So the technical backdrop is not very favorable right now, and of course that just amplifies the Cyprus issues and the whole pretext of the bail-in situation that they've gone through over there, and certainly that's increased risks in the Eurozone because people are becoming increasingly concerned that we could see similar situations, if required, enacted in some of the other Eurozone countries. So, the structure of the banking system outside of Cyprus is very different, and so I think the probability of using this bail-in type of thing for depositors is much lower in other countries, but still I think the events in Cyprus have created a precedent. It's increased risks in the Eurozone in that respect, and so the markets become much more cautious. Now, in terms of our forecasts, basically over the next month or so, we have a forecast of 129 for the euro, and then looking out 6 months, we're looking at 127, and then 12 months, 125. So certainly from the profile of our forecast, the general bias would be to use shorter-term rallies in the euro, use that as a selling opportunity given the increased risks that are out there.
And the yen softened today ahead of April 3rd to April 4th Bank of Japan meeting. George, what do you think are the main risks facing the yen right now?
In terms of dollar yen, I think the risks are that we might be a little bit disappointed with the outcome of the April 3rd and 4th Bank of Japan meeting. Certainly, given the sharp magnitude of the rally that we've seen in dollar yen since last October, I think most people in the market are expecting very, very bold, very, very decisive actions from the Bank of Japan in terms of meeting their 2% inflation target. And I think the risks are at this juncture that the market becomes slightly disappointed in the sense that obviously we've priced in a very proactive and aggressive stance from the Bank of Japan with respect to quantitative easing. And I think what we're probably going to have to see in order to get another leg higher, given how stretched valuations are right now, is perhaps the introduction of something more radical, such as the purchase of foreign bonds. And they seem to be ruling that out for the time being. And so I think the risks are that we see a little bit more of a pullback in dollar yen based on valuations. Now, in terms of forecasts, over the next month or so, we're looking for a move down towards the 90 area in dollar yen. And then 6 months out, we're looking at 85, and 12 months out, we're looking at 82. So basically, given that forecast profile, we're still questioning how successful the Bank of Japan is going to be in terms of generating enough momentum to meet that 2% inflation target over the next year or so. And as a result, we do see some downside risks for dollar yen on the back of that.
And finally, the Canadian dollar has been trading close to 5-week highs today as Canadian consumer prices rose more than forecast last month. Now, George, how are you feeling about this currency?
I think over the very short term, we could see a little bit more downside in dollar Canada. But that being said, from a technical standpoint, the valuations are starting to move towards oversold levels. And the market has become a little bit more cautious with respect to Canada, and I think the main driver of that has been interest rates, in the sense that up until about a month and a half ago, the market had still been leaning towards rate hikes in Canada, and that was largely driven by hawkish rhetoric coming from the Bank of Canada. Now, at their last interest rate decision, they've had to tone down that hawkish rhetoric, given some of the weak spots that we've seen in terms of the Canadian economic data. And so we think that creates some downside risks for the Canadian dollar as we go forward over the next 6 months or so. So in terms of forecast targets, over the next month, we're looking at the 104 level. And then looking out 6 months, we're looking at 105. And then over the next year, we're looking at 103. So certainly over the next 6 months or so, we see some downside risks for the Canadian dollar emanating from that shift in terms of the interest rate dynamic. And then we think we'll see some stabilization and also a pickup in the growth dynamic in the second half of this year. And that should create a little bit more of a positive environment for the Canadian dollar.
Thank you very much, George. Well, viewers, that is it for right now, but do stay tuned to Dukascopy TV for more economic analysis and Forex updates. But for now, enjoy the rest of your evening.